So this session's on global risk assessment for pensions and other non-bank financial institutions. As I thought about the three papers, the challenge is how to tie the three together. And what struck me and troubled me is the definition. What is systemic risk in the context of pensions, life insurance, and other long-term instruments? I'm really worried that the problems are being thought of from the perspective of the global financial crisis, the defaults that occurred then, and the people that are doing a lot of the analysis and arguing things are systemically important in many circles are people with banking backgrounds and thinking about the problems from those perspectives. And those may not be the most appropriate to consider the risk assessment for pensions, life insurance, and other long-term instruments like that. So I think a place to start is a definition. So I'm proposing a definition that systemic risk in the context of pensions and life insurance and other long-term savings is the risk that those included in the system fail in a timely and accurate manner to receive their pensions, life insurance, and other long-term savings benefits, and longer term that system failures impede inclusion and growth in the formal system. So the definition is that people who expect to receive certain benefits don't receive them, but it's also important to think longer term, because the timescales, and I'll get to this in a minute, are long-term in nature, that something could go wrong that slows down inclusion and growth in the formal system and leads to the credibility of the system to suffer because people have very long memories. In this context, I have three concerns, okay? And the first is this issue about source of risk. So we don't really understand when we think about pension funds and life insurance as systemically important, how much of the risk is actually coming from the long-term benefit side. So for instance, if there's a cholesterol blocking drug that comes all of a sudden that leads to expected mortality changes that causes insurers to go broke, that's clearly arising from a life insurance or, depending on how you look at it, which side of the coin, that consideration, that's a risk that's directly in that space. So how many of these risks are leading to the systemic risks we're talking about, and how many of them are coming from somewhere else and affecting pension funds and life insurance and making them have issues? If it's the case that there are some firms that are systemically important, yet these longer-term risks like mortality or morbidity changing and things like that don't really impact on these things, but these firms are systemically important, it doesn't necessarily argue for more capital for these entities. It argues that you might need to change the way they're organized. You might need to segment things. You might need to have segmented funds, or you might need to force separations of entities. So I'm concerned that the thinking about systemic risk on pensions and life insurance is too narrow because it's not thinking about the source of risk. It's not really capturing that well enough. And therefore, more capital and the sorts of regulation that the bank regulators or others that are involved in regulating traditional systemic risk would bring to the table isn't necessarily the right type of approach. Second, the definition of failure. I'm concerned that default per se is not the only risk. And I was particularly struck by Franklin Allen's talk last night, Navinder Singh Sarao, sitting in Hounslow, managing to bring down a whole system. He didn't cause any bankruptcies. No bankruptcies. No, the failure, which is traditionally defined as systemic, is bankruptcy. Nothing went bankrupt, but things didn't work. So in the definition I'm using is a failure in a timely and accurate manner to deliver things. And in that context, I don't actually know if default's all that important when you talk about pensions, and you have occasional defaults of life insurance companies, but they're guarantee funds and there are various other things that get dealt with over time. But there are things that could lead to market failure that are quite significant. And as we tend to focus on the last crisis, we don't necessarily think about things that could happen in the future. So when I was listening to Franklin Allen's talk, I was thinking about the case of Sony, because we've had a lot of focus on information security that's based on privacy. Yet the Sony case was one of vandalism. Okay, now what if someone were to break into a system of a fund manager or a pension fund and just delete records, an advanced persistent attack where people's entire records of savings just disappear, including the backups. So in an extreme case, someone goes in and deletes the Internal Revenue Service records for a year in the backups. I mean, what does that do systemically to the system? So if we're talking about people receiving their benefits, records are pretty important. They're occurring over very long periods of time. And when we say, you know, a firm that's systemically important needs to have more capital, that doesn't deal with issues like this. So the definitions of failure are, at least in the context of pensions and life insurance, are far too focused on the global financial crisis and not the sorts of things that I think could happen going forward if allegedly North Korean attackers who I mean, the access to electricity is so limited that a lot of the imports from China televisions are actually solar powered, can actually bring down a major motion picture theater. Think about what someone who doesn't like certain aspects of the healthcare system or something could actually do in an environment where we're very much interconnected. And if people don't, if there's a significant failure because of something like that, that would propagate through the system and really cause a lot of harm. And there are other definitions of failure you can think of that occur if you go back to some of the FINDEX, the countries there that are much less traditional. Just like think about the issues in Nepal, where whole institutions could be destroyed and people would take some time to get their benefits. How do we actually model that sort of failure in context of things like FINDEX? Because I think we're thinking about systemic risk too much from a US, UK banking point of view. Third, the time scale of risk. So when we think about pensions, life insurance, and a lot of the long-term savings, it's much more about slow failures and credibility than something sudden. And we have to figure out how we deal with that. So cases like in Japan, where the lower interest rates lead to a difficulty of meeting obligations that occur over time, and people's belief in the system and the credibility of the system declines. That's a very significant risk, but it's not something that you deal with traditional methods or with capital. So I'm concerned that, I mean, these are all papers that are very good. Clearly, I have comments on specific things with them, and I think that we need to think very carefully from a research perspective. How do we define systemic risk in the context of pensions and other long-term vehicles? How do we build it into the regulatory discussions, and how do we build it into the databases and other approaches we're using to capture these things? Because just for instance, measuring inclusion is great, but we should also measure the degree of vulnerability, the risks people face, and actually try to characterize those risks so that the system's as sustainable as possible. Thank you.